How will stocks and bonds perform for the rest of 2025? Hi, everyone. I'm Maggie Lake, and today I'm talking markets with Vincent Deluard, Director of Global Macro for StoneX. Hi, Vincent. It's great to have you on again.
Super happy to be back.
That is a big question to ask, but it's exactly the challenge you're taking on in your latest note. Tell us about it.
Well, so I mean, it's a little tongue in cheek, right? So I, I'm probably feeling high on my own supply because I had a good call on calling for a correction in March. I mean, we actually did it together. I think that was our last interview. It was probably around December, talking about, okay, this is going to look stagflationary and the market is vulnerable. We could see a 10% pullback in March, and wow, just on the clock, you know. So now I'm feeling like I got this.
and willing to stick your neck out even further. I laughed in your note. You said you should never put like a market prediction and a date in the same sentence, and yet you're willing to
So
do it.
I'm gonna do that intro. Okay, shall I just start with the end and tell you exactly how the rest of the year is gonna play out, and then we can talk about why?
Yes. Yeah,
So,
let's do
all
that.
right.
But I just want to, for anybody who might be traveling and listening to this, it's a perfect time to talk about it because we are seeing, after the decline that you called for, we are seeing stocks regain their footing. And in fact, it's been a pretty strong day. We have the NASDAQ up over 2%, the Dow and S&P both up well over 1%, the S&P almost 1.75%. So it's looking like a good day. But tell us what you see, and then we'll unpack it.
All right. So the title of this week's report, my latest report, is called Spring Rebound, which we're getting, Summer Lull, and Full Correction. So yeah, last week it was pretty obvious to see that, we're getting pretty oversold on stocks. We're getting to quarter end. So quarter end is a very important time because you see a lot of rebalancing. Target date funds especially need to get back to target. In that case, that means selling bonds to buy stocks. And I think we're certainly seeing some of that. There are other factors, seasonal factors that have to do with tax payments. And then I suspect earnings that are, going to calm the market in the short term. So yeah, I would expect to see, it's normal, if you look at in a normal bear market, usually you have a first wave of selling, and then you retrace some of that. And I think we're in that retracement period. And then I think this is where my entire outlook hinges. My view is that bond yields will keep ripping higher. And obviously this day was amazing. I mean, just today we did half of what I expected would do in the next 5 months in terms of yields. But my idea is that yields are going to creep back up. We're going to get to 4.5, 4.67% by the summer. And then if that happens, we have a sequence of potential squeezes on liquidity in the summer, combined with low growth expectation with stocks and 5%-ish bond on the 10-year. I think you could see another 10% down. So that's the idea. We rebound, then we drift, and then we drop again. And the main driver of that is really bond yields.
Yeah. Okay. So let's talk about some of the circumstances and situations, and also kind of where this differs from what the market's pricing, because I think in a lot of ways people are not expecting this. So first of all, in terms of this bounce, one of the things that we are seeing, and you rattle off a bunch of reasons, but the point is that there are several different factors coming together to lend support. We're seeing headlines. If you look today and open up your browser, you're going to see the market's rallying because now they're not as worried about tariffs. Do you think that that's overstating it, or is that one factor that's feeding into this? Because, last time I checked, the tariff narrative changes every single day. So it seems a bit odd to say that suddenly everyone's decided that they're not a threat.
Yeah, for the sake of mental health, I decided to no longer follow the tariffs because I have a job and, I need to be able to think instead of just reacting emotionally to whatever comes through. My general impression on tariffs is that, yeah, it's real, it's happening, and don't oversweat it. We're talking about, how to write these headlines and telling me that you did that in a prior life. I mean,
Yeah.
quite often, you see something happen in the market and then you look for something in the conversation that may justify that. But listen, I mean, and that's why, by the way, I hate to do the Bloomberg and CNBC stuff when they start the question, why is the market up today? And my answer is more buyers and sellers.
Yeah.
And that's it. And literally today, I believe this is the case. Like we're getting to the third week, so the last week of the third month of the quarter. We have a bunch of people who got caught off guard by the correction. And now they are massively underweight stocks, massively overweight bonds. Some of the pension funds have payments that they need to do in January. So in April. New money coming in as people get paid. So where are you going to allocate that new money, right? I mean, if you're underweight stocks and overweight bond, well, you're going to allocate to stocks, obviously. And then in order to meet your payment, you're going to sell some bonds. And then you get a day like today when the stock market is up, 170 basis points and the 10-year yield is up almost 10. So I think that's all that there is. And then again, like that tariff story. So if tariffs are not a threat, why are bond yields up? I mean, there's so many things that don't add up, right? So sometimes it's just the tail is wagging the dog, and this is something that my good friend Mike Green has been talking for a lot. I mean, when you have a market that's more than 50% passive, this is not the world that Bill Sharp envisioned when he wrote his paper as the passive sector being kind of a silent observer and a price taker from the active sector. I would say it's the most exact opposite. The active sector is a price taker from the flows coming from passive, and today is one of these days.
Yeah, no, that I think that's really important to keep reminding people of, because it's easy to, get sort of sucked into the headline and assume that's it. But if you're making decisions based on that, it's going to be problematic. So you, in your scenario, and I thought it was interesting you say this, bear markets will do this. There are a lot of people who are saying the bottom's in, is the bottom in for stocks. And you definitely don't see it that way. Is this a selling opportunity? Should you be selling into this strength if you are worried about the future?
Well, I think the big question about the bottom is about yields. Is the bottom in for yields? And then depending on how you answer that question, then you get your answer for the equity market. So my view is that the bottom is in for bond yields. And that as a result, the bottom is not in for equities because yields are going to drift higher. That's going to decrease your equity risk premium. And that's going to mean we're going to have a second leg. Now, if there's another scenario, and I'll talk about it in upcoming research reports, where those works, tariffs raise money, oil prices fall, the Fed cuts, and by the end of the year, we're looking at a deficit that's maybe $1.3, $1.4 trillion, decent growth, couple Fed cuts. Yeah, maybe then yields can fall lower. Maybe we can see 3.5 on the 10-year. That would not be my base case scenario. My base case scenario is that yields are going to drift higher, and as a result, I expect more weakness for equities. Now, about the timing of that weakness, I don't think it's immediate. No, like the process that we're talking about, that rebalancing, is going to happen at least until the end of the month. And then after that, we have the April tax deadline, which I think is going to help the market. I think a lot of the weakness that we've seen had to do with the fact the market was up so much in the past 2 years. People had massive capital gains, and in order to cover these capital gains, either you had to sell some stocks. I happen to live in the Bay Area, unfortunately, for my mental health. And, I see my friends who have literally tens of millions of dollars because they have a job, and that job happened to be at stuff like AppLovin or Palantir or NVIDIA that are up, 5x last year. So and they get more than half of their comp in stock options at a certain level of seniority. Now, the unrealized capital gains on these things is, enormous. And it's taxable. Like the IRS treats RSUs as income. So when you don't sell, you are still hit with the tax liability. So
you've got to sell just to cover that.
Exactly. And quite often the companies themselves force sell. Most large tech companies, they will just sell off share so you don't get hit with the employees hate that, right? Well, why do you have to, like, it could be like $5 million in taxes. I mean, if you are that, and that's because obviously your stock is up 500%. I mean, you're not poor by any means, but you may not have liquidity.
Yeah.
So we are seeing some of that selling. All of that is going to abate after April 15, which is one reason why I think some of that selling pressure on stock that we've seen so intensely in March is going to go away. And then, we'll move on to the flow of economic news. Tariffs are on, tariffs are off, blah, 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 recession, this or that. But my guess is that the economy was insanely strong in Q4, which I think is why Q1 was disappointing because we're coming from such a high base. But now it seems that the expectation is that the recession is around the corner. I doubt it. I mean, I do think the economy is slowing, but we're so strong that even slowdown means that we can still have decent growth, and we will not see kind of the bloodbath in earnings that some investors expect. So all that could help kind of stabilize the market in the coming weeks.
Yeah. Hey, everybody in the chat. Gerard, I think that answers your question. He was asking what you think the odds of soft landing, no landing, or recession. And it sounds like you're kind of in the, I don't know if soft landing is right. Stagflation.
I don't know where that falls.
Yeah.
I mean, there's definitely a landing on growth. So as you know, I'm a big fan of looking at tax collections instead, because especially now I feel surveys are just wasted energy, right? I mean, if I know how you voted in November, I know how you feel about the economy, right? And if you're Democrat, you think, all hell broke loose, and if you're Republican, so just look at the tax collection, and in the tax collection, it was insanely strong, December, January, and it's slowing down significantly now. So I see growth as slowing. And then I've long been in the camp that inflation is sticky and tariffs are probably making that worse. Now, of course, if there's an economic slowdown, that's going to pull down inflation, but my guess is it's not going to be quite enough to justify Fed cuts. So we'll end up in this really awkward position for policymakers where, okay, my growth is slowing, but at the same time, inflation is still too high. So I can't really ease all that much, which seems to be what Powell was trying to communicate last meeting.
Yeah. Are you surprised that they use the word, that they're sort of thinking about inflation as transitory?
Yeah, given the history there, that was not the.
I can't believe they just didn't find another word, even if that's what they were, given all of the angst around that word again. But
I would suggest listening to Christine Lagarde, because it's always fun. About 3 years ago, she went on a really long explanation on the bump. On a hump, and then she even made the gesture like it's just a bump, but then the bump goes up and then it flattens and then it goes down. We're still in the middle of that bump. So maybe bumpy inflation is better than transitory.
Yeah. So a lot of questions about the 10-year, about bond yields. And 100A are saying, please send the 10-year yield down so I can refinance my mortgage. Speaking to you, Vincent. But there are a lot of people who are hoping to see yields come down so that they can refinance or get a mortgage rate or refinance their car loan. And you don't see that in the cards.
No, I don't.
Because of inflation.
Because of inflation and because of supply and demand concerns. Also, I would point that the for the mortgage, you need to clear the low to get some refinancing activities meaningfully. So when we had this silly summer panic last summer, when everybody was freaking out about imaginary recession, 10-year yield went like 3.8. So if there was any refinancing activity, it happened there. So I'm not sure that even dropping to 4 really eases the economy, because again, you have to make a new low to really get refinancing. So I'm sorry about your viewers' question. I'm not gonna single-handedly cause borrowing costs to come down here, and my expectation is that they get back higher. One is the stickiness of inflation, and 2 is really just supply and demand. I think the biggest problem that we have policy-wise in the U.S. is a duration one. This is the poison legacy of Janet Yellen. So when Biden was running these huge deficits, initially we tried to finance them, just increase issuance by 20% across the curve, and we had a couple really bad sell-offs on QRA days. And then we saw what happened with Liz Truss in the UK when the bond market basically forced her out of a job. So rationally, but not very bravely, Janet Yellen decided, well, if I risk losing my job, I'm just going to do the Brazilian thing and finance everything on the credit card, put everything in bills. So as a result of 4 years of over-issuing bills, now the maturity of U.S. debt is very low. It's less than 4 years from an average of 6-7 years usually. This is not responsible policy making. I mean, this is basically means that you have to refinance $10 trillion every 6 months. It's like running on a treadmill whose speed is always increasing. So the Treasury needs to issue more coupons. At the same time, the Fed has the same problem. When we did QE, we bought all around the curve, right? It's just buy everything, including MBS, very long duration there. And then when we did QT, the things that matured are naturally the bills. So over time, the maturity of the Fed portfolio increases, even though it's not doing anything; it's just letting things roll off. So now the Fed, if you look at the assets on the Fed side, it's probably like around 20 years duration on the Fed. So you have 20-year duration on your asset side, and then one day on the liability side, technically it's bank reserve and reverse repo. So every time yields go up, you lose a bunch of money. Now, of course, the Fed cannot go bankrupt. You don't have an enforceable claim on it. It's not like Silicon Valley Bank, even though it looks like it. But that still means that you have to report these very embarrassing losses, and you cannot give money back to Treasury. So from a pure risk management, Powell wants to shorten the duration of his portfolio. Powell wants to extend the duration of the debt. We need to issue a lot of long-term debt. And again, supply and demand, that means that the term premium will shrink by about 50 basis points because, Elon runs around making memes about cutting government waste, will go back up. And that's my explanation. That's really my biggest reason why I think long-term yields are going to go back up. It's really supply and demand. And my guess in terms of timing is that that's going to happen when we solve the debt ceiling. Right now, we can't issue a lot of new debt because we don't have a debt ceiling agreement. But as we have one, we'll have to refill a Treasury general account. We'll have to issue something like 500 billion, and a good chunk of that is going to be at the long end. And my fear is that that's going to push yields higher.
Yeah. So, the question no one wants to ask what if no one turns up for one of these auctions at the long end, right? This is hitting at a time when we're seeing capital moving away, or at least a very strong narrative right now is that, the U.S.'s kind of golden age of being the most attractive asset market in the world is over, and you're entering a period where capital is going to reallocate to other markets. Right now, it seems like that is a real reallocation of their money back home, a repatriation back home, as opposed to U.S. money going there. But is that something that you think is going to happen? Is that a risk?
I believe in the general process that you described, like the renationalization of capital. I'll talk about it a little bit. In terms of like seeing a failed auction, no. I mean, the auction will clear. There's always a market price that clears buyers and sellers.
What yields would have to, what would they have to do for yield?
The yield would be higher and the volatility would be higher. And at the end of the day, what we're witnessing is a normalization of treasuries as a normal asset with normal volatility, and where prices need to meet supply and demand. We're losing the price insensitive bid of foreign central banks that are just buying treasuries because they're managing the peg, or they want to build a strategic reserve. These guys were buying no matter what. So that was almost like a put, if you want, on treasury prices at auction. So yields are, long-term treasuries are going to behave like a normal asset, and a normal asset has more volatility. And if there is supply and demand balance, it makes sense for prices to go down. Now, in terms of your, I think the way you summarized it was excellent. We are, to me, I would link the two. I mean, if you look at a balance of payment, it's really a mirror. You have the trade account, and then you have the capital account, and then they move in opposite direction. I mean, that makes sense, right? If you consume more than what you produce, somehow you must be selling assets or borrowing the money. So you have a deficit in the trade side, you have a surplus in the capital account side. It seems to me that the entire world is saying we cannot live with these imbalances on the trade side. For America, it's kind of strategic job. For Europe, it's more about climate change, and maybe we shouldn't import milk from New Zealand when we have good cows in Ireland, stuff like that. But everybody seems to be trying to say, okay, this has gone too far, and the parallel to that, of course, is it's gone too far on the capital account side, and the capital account that the U.S. being the largest deficit country on the trade side has the biggest surplus on the capital account side. So that is a very easy way, the most natural way for foreigners to retaliate against Trump's aggressiveness is just, yeah, okay, I'll allocate back, like if you're Governor Trudeau, or like or Governor Carney now, you give a call to Ontario's teachers plan or Caisse des Pensions et Dépôts in Canada. Say, hey, what's your allocation to U.S. stock in Canada? Let's flip that. Or let's shorten the duration, and then you do the same thing with the European banks, the German insurers. Hey, we're building an army tomorrow. We're gonna need your savings. We're gonna give you that new bond, and that basically means that European savings stays in Europe, Japanese savings stay in Japan, and the country that benefited the most from this global circulation of capital will suffer the most, and that's the U.S.
So, and I think this is the kind of conversation that gets people scared. I'm going to follow up on that second, but I want to get this great question in from Els Bells. How does 2020 stagflation with only 3 to 4% inflation compare to the 1970s stagflation with 15 plus inflation in terms of the impact to various asset classes?
That's a very good question. First of all, there's always a chance we get much higher stagflation. Who knows what happens? I mean, in the 70s, it did not start 15%. There was a couple of waves that got us there. By 1975, it looked an awful lot like today, where inflation was at 4 or 5%, not 15, and it took the second oil shock with the Iranian Revolution to push things that high, and who knows. But yeah, bar some sort of black swan, I would agree with the premise of the question that stagflation is going to be less strong, which means that maybe it's not so bad. Right, 70s was just brutal. I mean, if you look on a on a real total rating basis, I mean, bonds got obliterated. Stocks probably lost half of their value in a decade. And then if you just compare to gold, I mean, which was a standard before, so that should be the benchmark. I mean, everything went down like 95% plus. So it may not be that bad. If we're talking about 3-4% inflation, well, 10-year yield is at 4.5%. So you have a bit of a buffer. I would expect in this world that bonds have zero real return. And then for stocks, I mean, it will be volatile. But if we avoid a recession, yes, earnings should keep growing. But I think we should be ready for a world where, you 60-40 portfolio that, I mean, it's been insane. It's been almost 10% a year for a decade now on a 60-40. I mean, that's probably going to be like, in real term, maybe 1 or 2% real term for a 60-40 portfolio.
Which is not, a lot of people see that when you've been looking at 10%, and that's itself is a shock to the system. When you were talking about, the capital moving out and a rebalancing of trade, I think that a lot of people think that, maybe the world is in need of a rebalance. I think somebody in the chat was referring to something else, but the whole idea that all of this, while big change could be a necessary reset that the global economy needs. But Michael Cow brought up something really interesting to me one time, and he was talking about the sequence of things. And so it seems that shifting that trade, reshoring, making things, shrinking your supply chains for whatever reason you're motivated to do that, whether it's retaliatory or just, better policy or national security, that seems like a tanker. That seems like a longer process. Capital allocation out of the U.S. into another market seems like it could happen much more quickly. Is that a concern that one happens before the other? And, how at risk is the U.S. given how financialized our economy seems?
Yeah, I absolutely think that's the sequence. I mean, you're absolutely right. I mean, asset allocation decision is one click. Building building a plant is a multi-year process. So I would expect the pain to come first and then the reward to come later. And
Mm,
if you listen to what Trump and Besson have been saying, it's exactly that, right? The detox idea that we lived in this unsustainable world, and that if we want to get out of it, we've been hooked on foreign capital, cheap stuff from China, excessive debt, and there's gonna be a kind of hangover period before we can reap the reward. There's even the view that they're being quite deliberate about it, trying to get the pain first right now, so that by the end of the mandate, things look better.
mm.
I'm not sure it's that calculated, but by definition, the pain comes first, and any reward from um, greater domestic activity, higher wages will come in much later.
Yeah. What is the pain threshold for treasury rates, do you think? I mean, we managed at 4.5%. That seems like we've been there several times in the last
Yeah,
few years.
yeah.
What level would you start to get concerned about having a really negative impact on the economy?
I think you're right. That 4.5 to 5% is where the pain point has been. I would think that maybe that pain point drops with time. So in the sense we become
Used to
more
it?
sensitive, right? Because nominal GDP is falling, right? So when we're growing at 6-7% nominal, which was the case for most of Biden, right? We're at 3% real and 4-5% inflation. So yeah, 5%, no problem. You still have negative real rate. Now, as the real economy slows, which is what we're seeing today, and inflation is kind of bottoming out. 4.5% becomes more restrictive now than it was
Mm,
12 months ago. The other reason is also the passage of time, right? I mean, we had this massive refinancing boom under the the COVID years, right? When you could, I refinanced my home at 2%. This is insane, right?
you can never
Corporate
move
bond.
again, Vincent, but
I like California. And so people so the effective rates that people were paying was not that high rates, but the more
mm,
time passes, the more and more debt reprices. The average maturity of corporate debt in the US is 5 years. So bonds that were issued in 2020, 2021 are going to mature in the next 2 years. That's going to be rollover. So you'll see the impact on margin. So the more time passes, the more that I think that pain point kind of drops.
yeah. So when we're talking about stocks going down potentially another 10% in the fall, treasury yields going up and it becoming restrictive, maybe a slowdown. We'll see whether it's a recession or not. It's not definitely in the cards. Like there's a chance we avoid it. It sounds difficult but manageable. What are the risks that this snowballs into something more serious? I mean, can we make that transition with all of that you laid out without something breaking? Like, what would you be looking for? Where would you be concerned to say, okay, this isn't just going to be a detox. This is going off the rails.
There are two areas that would. First of all, the geopolitical stuff. I keep worrying about something really bad happening, like going to war with Iran, or like that. I still think we, unauthorized, Israeli strike on Iranian nuclear sites, or something like that. I mean, that probably is not high, but it's not zero either. And I worry about that because that's like an existential threat. Bar that, I would look at two things. One is liquidity. So for pretty much since really the great financial crisis, we've lived with excess bank reserves. The Fed injected too much liquidity, and liquidity is never. There's a brief accident report mark in 2019, but for most of the past 15 years, we had too many bank reserves, and we knew what to do with them. And we're getting to the point where it's close now. I mean, you look at the reverse repo facility. There's probably 600 billion left in there. So the reverse repo facility is the sponge that sucks in this excess liquidity, and now it's almost depleted. We are 2.6, now it's 600 billion. So it's not impossible that by the fall we're at zero. And if we have zero on the reverse repo facility, you need to start draining bank reserves from the deficit. And we don't really know, because we ran this experiment of excess liquidity for so long, what is the level at which things break. My suspicion is that we need more liquidity now than before. The rule of thumb is 10% of GDP. I think that goes up as the economy gets more financialized, right? Because at the end of the day, liquidity serves to buy assets, and we just issued so much more asset. We have a bigger debt. We have private credit that barely existed a couple of years ago. So maybe that the relation is not so much 10% of GDP, but 10% of financial assets, in which case maybe it will hit before, and we have liquidity problems. And then the second one would go back to this kind of private debt, private equity, VC bubble, where my general impression is that we pushed capital in the shadows with excess banking regulation for the past 15 years. After 2008, we decided, okay, that never again, the banks, we're just going to hit them with regulation so they don't lend. And of course, nature abhors a vacuum. So where the banks pulled out, new actors came in. So we saw companies stay private for much longer. We saw a lot of money going in private equity, VC. These guys not marking to market at all. Like you can look at, the great thing if you're investing in the NASDAQ, you're down 20-25%. But if you're in a VC fund that is way more speculative than the NASDAQ, you're flat. You're not flat, obviously. They haven't marked down, so there's some risk there. And then private credit, right, which are really taken over banks. I mean, the marginal provider of capital in the U.S. is not JP Morgan or Wells Fargo. It's something like Blackstone or RS Capital or a private lender. And I look at these guys. I mean, on paper it looks great, but I'm like, wow, they have their 10% return on cap. How do you squeeze 10% return on the US? I just don't know. Like somewhere there must be leverage or lending to really low quality borrowers. And if we see the economy slow, typically that could hurt. But again, because we moved it out of the public market, it's very hard to tell, how much of a buffer we have and whether these losses could kind of cascade.
That makes me so nervous when you say that, because it's exactly the what we couldn't see in the great financial crisis that just became a black hole that sucked everything in. So that's really, really concerning. And also,
the one thing I'll say about, that model, philosophically, I think it's better to finance it, because the end capital in this private lending strategy are high net worth individual, endowment, pension funds. So and there is lock-in periods. So it's probably better to finance. There's a better ability to absorb losses than when it's banks. We have deposit.
You don't have the run and the retail,
exactly.
right?
So we have less of that risk. So that. I mean, that's my hope, and I think that was, the system may be more stable as a result of moving lending to kind of long-term actors that don't have immediate liquidity needs.
Right. So as we finish, what looks attractive here? I mean, where do you find a safe haven from this turbulence that you see coming?
I mean, the short term, I think stocks are going to go higher. I think we have like a path for, a good stock market rally. We're probably not going to make a new high, but we can retrace quite a bit. And then, medium to long term, I'm a believer in this global reallocation. So the countries that exported the most capital will benefit the most from the repatriation of that capital. So I'm a believer in a rotation away from the US. I think the MSCI ex-US is going to keep outperforming the MSCI US. And within that, I think the thing that did the worst are probably going to do the best. So the worst possible investment for the past 10 years, we are Chinese stocks, Brazilian assets. Europe has already rallied quite a bit.
Yeah.
I mean, so far it's amazing. I mean, the trades work so beautifully. I mean, the US is down 10% and the rest of the world's up 10 with, China up 30. And then if there is a resolution, a happy resolution to this, age of imbalance, if we can do it the friendly way, we're getting everybody around the table and say, listen, I mean, let's not do the tariffs, but okay, the US has a problem right now. We need to maybe restructure the US debt, swap some of it away from bills into zero coupon bonds and lower the value of the dollar, the idea of the Mar-a-Lago Accord. If that happens, I think we get the dollar index down. I mean, that's what the world needs. The world needs a lower dollar, and if we can collaboratively get there, then the countries that borrow the most in dollars would get the biggest boost. And again, that needs to be back into LATAM and some other Asian emerging markets.
Amazing stuff, and good to be exploring that possibility too. It seems that people feel like it's unlikely, given some of the rhetoric we're hearing, but that would be the ultimate deal, and always worth. And I know that you always challenge yourself to look at what if it all went right, as well as what's coming up. So good, Vincent. So great to get the update, and I love that you're willing to look out a lot further than people usually want to about what might come down the pike. So we're definitely going to catch up with you again soon to see if it's all playing out.
Thanks, Maggie. See you soon.
Thanks everybody for the great, and I love everyone sharing their portfolio ideas, which is amazing. So if you want to comment after, if you're watching this on replay, please do so, and we'll take it up. But thanks everybody. Appreciate you all. Take care and good luck out there.